Tony, the Fed has so many programs under sort of its wing now that it's almost hard to keep track of them. What has it meant for you as a fixed income strategist? What do you say to your managers?
Well, hi, Bonnie. Good to see you. What we say is that the Fed has, we think, certainly done a very good job of handling the immediate liquidity seizure that took place in markets and starting to build a bridge for the economy to kind of work through this period. But the thing that we think is most critical is that you want to be focused on the areas where they are directly impacting the market with their purchases. So obviously treasuries and mortgages were two of the first. But then as they've extended those programs to impact kind of the higher quality segments of the fixed income market, whether that's investment-grade corporates or some of the municipal investments that they've talked about implementing programs for, we think those are the areas to focus on. That's where we've seen the most positive reaction in the market. As you extend kind of out the risk curve into lower quality segments of the market and into the areas that were more hard hit by the COVID-19 crisis, there we are a little more conservative about thinking that that's an opportunity. So right now it's following the Fed as their balance sheet is really taking the place of otherwise real money investors and helping to support those areas of the fixed income market.
So, Tony, where are you adequately getting rewarded for the risk that you take? Everywhere, or are there still some dislocations?
Yeah, we think that there's still opportunity when you look at, again, like investment-grade credit, prefers, investment-grade municipals, a lot of the asset-backed market, particularly consumer-related sectors. Those are still trading at levels that represent, recessionary conditions, and we think relatively good value if you can look out across a kind of, call it 6-month to 1-year time frame. It's in the lower risk, lower quality segments of the market where we've seen a rebound, and we think that there you need to be more cautious. So when you talk about high yield and emerging markets, for example, there we're comfortable in the higher quality segments of those areas. But as you dip into the lower quality segments where the Fed is not going to be directly operating, there we're still cautious given that we're expecting a more muted, gradual recovery in terms of the economy, both in the U.S. and globally, as opposed to a V-shaped recovery that some are expecting.
So, Tony, clearly I can't interest you in anything related to leisure or travel or retail, but will there be demand if these companies go to market to try and survive, or do you see a wave of bankruptcies and even more fallen angels coming?
We definitely think you're going to continue to see downgrades, so fallen angels. We certainly think bankruptcies, we've only begun to see the initial stages of the bankruptcy wave. You see estimates, for example, in the high-yield energy space of 40 to 50% default rates. You see overall default forecasts for the high-yield market in the 10 to 12, 13% range. And right now we're still at 5% for the overall market. So we do think that the preponderance of the bankruptcies are still ahead of us, and that's why we think you need to be more cautious. Now, bottom up, if you can find good, solid companies that happen to be over-leveraged but have a good market position, there you can find one-off opportunities. But in terms of a broad brush, we think you need to be very cautious when looking at those kind of COVID-19 areas of the market.
Tony, we're out of time, but what's the indicator you look at first thing in the morning when you, I was going to say come in, but you don't go anywhere these days, I guess you just open your Bloomberg?
I'd say two things. One is we're looking at company earnings because there we're getting a little bit of a read, even though it's still not giving us kind of the April and forward-looking. But company earnings and commentary would be one thing, and number two would be kind of what's happening with